company says soaring memory chip prices are driving up costs, and the AI boom is a major factor behind the surge.
A multi-billion-dollar bet is beginning to crack. Tech giants are funneling every dollar of their capital into an invisible asset. They promised an era of infinite technological supremacy, but beneath the aggressive hype, the actual financial returns are hitting an unbending wall. It is a modern industrial bubble funded by historic levels of debt. A single system flaw is currently disrupting the entire global market pipeline. How did the greatest technological bet in human history turn into a multi-trillion-dollar illusion? On June 2, 2026, the artificial intelligence trade reached a state of absolute euphoria. Analysts and investment funds demanded aggressive capital placement into tech equities. This absolute confidence relied entirely on a massive architectural expansion. To run AI models, tech corporations must construct windowless warehouses known as data centers. Each building houses over 100,000 processing chips. The cost to develop a single heavy AI infrastructure node spans $10 to $25 billion. Driven by this infrastructure race, the collective capital expenditure of the four largest tech conglomerates exploded from $90 billion in 2020 to a projected $725 billion by the end of 2026. Financial tracking reports indicate this aggressive capital injection will consume 94% of big tech's entire operating cash flow over the next 2 years. In 2023, that metric was below 40%. The entire system is gambling its future security on a single unvetted assumption that global demand for computing data will scale exponentially forever, turning this unprecedented debt burden into a massive economic bargain. In mid-2026, the underlying math of the core business model officially fractured. To justify this historic level of infrastructure capital placement, the artificial intelligence market must generate $650 billion in annual revenue. In stark contrast, the collective revenue generated by every major AI model company combined rests at just $75 billion. For every single dollar coming into the industry, the tech giants are spending nearly 10 times more on building capacity. This massive discrepancy has exposed an annual $600 billion revenue deficit. The corporate assumption was that enterprise businesses would pay massive premiums for AI tokens indefinitely, but executive data tracks a 95% failure rate among corporations trying to achieve measurable financial returns from AI deployment. In June 2026, software startups and major enterprises began aggressively cutting their AI budgets, moving their digital traffic to open source alternatives to slash costs by 90%. The commercial demand was over-responsible and irresponsibly oversold, leaving multi-billion-dollar data grids sitting completely empty without an actual revenue pipeline to sustain them. The consequences of this infrastructure overcapacity mirror a terrifying historical precedent. In 1996, the United States passed the Telecommunications Act, sparking an identical investment frenzy to lay fiber optic cables across the country. Intoxicated by the potential of the early internet, telecom cartels poured $500 billion into physical cables, switches, and network expansion under the assumption that data traffic would double every 90 days. Star corporations scaled to $47 billion valuations without ever generating a single year of net profit. By the early 2000s, the illusion collapsed. The actual internet traffic expanded, but it completely failed to match the overbuilt supply. Less than 3% of the installed fiber optic grid was carrying data. Over 97% sat completely unused underground. The result was a catastrophic $2 trillion market wipeout, plunging high-flying tech darlings into immediate bankruptcy. The physical assets survived, but the companies that built it were entirely destroyed. Today, the capital cycle is repeating its unbending mechanism, over-allocating hundreds of billions into physical servers before an actual consumer baseline exists to cover the debt interest. We live under an absolute assumption that technology shields us from the laws of basic economics. We believe that if a system is innovative enough, it is completely immune to a total collapse. But history proves that structural overcapacity always triggers a devastating financial reckoning. If the multi-trillion-dollar AI matrix fractures, the damage will not stay restricted to Silicon Valley billionaires. It will cascade through global service sectors, erasing tech jobs and freezing consumer capital overnight. Your entire economic security is currently tethered to a digital house of cards. If the giants of human innovation can miscalculate the world's actual demand by $600 billion, how safe is your own livelihood when the cycle flips